Good evening, everyone. As most of you know, we started GRIP 15 months ago in June 2020. About a month into GRIP, we came across Yieldstreet, and I still remember that feeling of validation and honestly of relief to think that we're not the only ones thinking about the lack of investment options being a challenge and the possibility of building a business around it. Since then, we have constantly been inspired by Yieldstreet, the pace of its business growth, and the value that it's delivered to its users. To have the opportunity to have this chat with Milind exactly a year later as we celebrate our 100 crore milestone is incredibly exciting, not just for me, but at the entire team at GRIP. Ladies and gentlemen, introducing Milind Mehere, a serial entrepreneur with a track record of building very large, scalable businesses and creating new product categories. He is the founder and CEO of Yieldstreet, a digital wealth management platform changing the way financial products are delivered and how wealth is created. Founded in 2015, Yieldstreet is headquartered in NYC with offices in Brazil, Argentina, and Greece. The company has become one of the leading global marketplaces for alternative assets and has facilitated over $2 billion in investments with 300,000 individual investors. Yieldstreet is accomplishing this by transforming the investing landscape, opening up access to investments for individual investors across a wide range of asset classes such as real estate, marine finance, art finance, legal finance, and commercial loans. Previously, Milind co-founded and scaled Yodlee, an edtech platform, to $200 million before exiting it to web.com in 2016. Good morning, Milind, and thank you so much for joining us on a Saturday morning.
Thanks for having me, Nikhil.
Perfect. We're going to dive straight into the questions, Milind. I know we're going to run short of time, so I'm going to try to make the most of it. The first one to ask any founder is inspiration, right? And I heard your interview. I think it was a slightly old interview, but I came across it recently where you talked about the inspiration for Yieldstreet being something you had gone through personally in the 2008 financial crisis. Would love to start there and just get your insights on what got you started on Yieldstreet.
Yeah, would love to chat about that. So listen, in some ways, my journey here to the US is very typical of many Indians. I came here for grad school, and that was close to the first dot-com boom, year 2000, and I joined the workforce, and I was asked and told that as I was getting successful professionally, that 60% stock, 40% bonds is the way to go when you think about your kind of financial investing landscape. And I remember 2008, 2009, when the world entered the global financial crisis. And I looked at my portfolio, it was down over 50%. And Citibank was, I still remember, 39 cents. For those of you, for those of us who had, obviously grown up in India, Citibank was like this global bank for 100 years, and it was, at 39 cents. So I called my financial advisor. I said, "Hey, what's happening? Why is my portfolio like this?" He said, "What can I do? The whole world has imploded." And that's when I realized that I'm overexposed to the stock market. And I said, "Hey, how can I, invest outside the stock market?" And as a consumer, I really felt cheated. I thought that I had done everything right. What was asked of me, I had a 401k plan, 529 plans. These are some of the retirement options here in the US. And in spite of all that, I felt that, I was left holding the bag, so as to speak. Obviously, being in New York, I had friends who worked in private equity funds, hedge funds, as well as I had access to some of the deal flow here in New York, investing in real estate, etc. My wife actually at the time used to work for a venture capital firm. So I asked my financial advisor, "Hey, can I get access to some of these funds like Blackstone or some real estate funds that can generate income for me?" And he started laughing. He said, "Milind, I know I am your wealth manager, but you really don't have any wealth." And so I said, like, "What do you mean? I'm like a pretty successful professional, successful entrepreneur." And, that's when I realized that the private markets are so closed and they're reserved for the top, 1% or 0.5%. And, the investments here were to the tune of high six figures or $1 million to get into those funds, and then you lock up your money for 10 years. And frankly speaking, Nikhil, that's really was like the first rallying cry for me, that hey, I need to do something else. So over the next several years, I did stuff through my personal account, but finally after Yodel's exit, I decided to do something about it, and like that's really was the genesis behind why I started Yieldstreet. Now, one point to note is that I don't come from financial services, right? And so I think really that's really where my co-founder Michael Weiss, he came from that alternative investing landscape, and like we kind of complement each other, where I really know how to kind of build a brand, marketing, and then obviously I'm a user, but he really understands kind of investment management, risk, compliance, all of those things, and that's really how Yieldstreet was started.
Understood. No, thank you. And I don't know if you track the Indian stock market regularly, but there is the Economic Times cover page today, which is the main business paper in India, as you would know. The first line today is that the stock market breached for the first time 60,000 as Sensex. And the reason that the journalist attributes it to is a lack of high yield investment options pushing extra liquidity into stock. Indian stock market has been the best performing stock market since the pandemic, and one of the reasons attributed not just by Economic Times but is the lack of other investment options. So, I think there is wealth available. It just doesn't have a place to go, and I think that's creating a very interesting opportunity, right? Milind, the Yieldstreet metrics, and you're very transparent about them, right? There's a lot of data available on the website about what the AUM is, how that's grown over a period of time. Outside of what we see on the website, would love if you can share maybe a couple of metrics that excite you. You peel one more layer of the onion that excite you about how people are behaving and getting excited about alternative investments and what you're seeing in the business.
Yeah, absolutely. So Nikhil, going to your Economics Times headline, I think that's the situation everywhere in the world, right? Including here in the US with NASDAQ and S&P at their all-time high. And I think it's a combination of a couple of things. First of all, interest rates are very low. Number two is the governments around the world have printed a lot of money and given it to consumers around the world, which some of it is making its way back into the financial markets because there are no other options generally available. I think for us at Yieldstreet, that's why we're seeing last 4 or 5 quarters have been one of the best in our history. And people are realizing that the asset values are really very, very high. The stock markets are very, very high. And, there are going to be shocks that always happen, right? For example, what happened with Evergrande in China last week. So they're always looking for options in terms of our user behavior. So outside of the stats that you shared, which is we have over 325,000 users that have invested now, it's getting close to $2.5 billion on the platform. I think one point from a user behavior standpoint that I don't know how many people outside looking in appreciate is that Yieldstreet is a self-serve platform. Meaning you really have to take the time to kind of understand it. We don't really have any advisors or salespeople that will call you. And the type of investments we offer, you really have to do a little bit of your own education and research. And so we pride ourselves in making sure that the consumer is well educated. And I think the behaviors that we see from them is that we have almost 75% of our users having multiple products with us, more than one. And the other stat we see is that over 40% have more than 5 products with us. And so once you start investing over a period of time, and we always recommend and advise our users to take it easy, invest in 1 or 2 things, see how they go, and then you can obviously build a portfolio. And so over time, they build a pretty robust portfolio with us. And I think so those are some of the stats that really kind of help us understand what our users want. The other important thing is that at the end of the day, what we are trying to do is help users diversify from that 60-40 traditional stock market exposure, right? And so that's really where that user behavior comes into picture. So as we launch new products on the platform, new investment opportunities, we see that users really take to it. The other key aspect is that retail really loves liquidity. So, so when you're a new user, one of the popular products that we see are either a diversified product like a fund, or we see short duration product. Like, well, that's how people would like to get started. And, everybody has their own ways of thinking about investments, but that's really some of the, behaviors that we are seeing.
Understood. I mean, you mentioned a few points, and I maybe take one up and then later on follow up on the other one. You mentioned about the the last 3-4 quarters being incredibly or an incredible growth for Yieldstreet. Do you think that and we're starting hearing about the Fed tapering the liquidity in the market, and so will other central banks? Do you see that changing? Do you see people moving away from all investments? Yes, I mean the heat will reduce, but is there likely to be a more significant change with respect to alternatives?
Actually, Nikhil, great question. My personal view is, and I spoke at a pretty popular alternative conference last week called the SALT conference here in New York. And my personal view, Nikhil, is that for the next 10 years, alternatives are going to drive the alpha in the market. Okay, and again, my views are more specific to the US because worldwide different stock markets are at different levels of maturity. But here in the United States, if you see the behavior in the last 20 odd years, what has really happened is that all the investing has moved to passive from active, right? And ETFs really and index funds have really kind of taken off. And in order to do that, you do through technology and fractionalization. You don't really need to be investing in a ton of mutual funds and stuff like that. You can put money in the indexes or ETFs and leave it. So where is and there is so much democratization and commoditization of product availability. So there is no differentiation. So where is the alpha going to come from? The other big thing is that I'll just give you simple stat because you're a startup and maybe some of your users and audience here might have exposure to startups. So there are 800 unicorns that have collectively $3 trillion of market cap. Okay, so think about the generation before us, especially here in the US. They made a lot of money because of some of the massive bellwether tech companies that their parents were able to invest, right? Or one or two generations above us was able to invest. So think about Cisco and Microsoft and Apple and Sun and Oracle and SAP and IBM. The list goes on. Last 15 years, all the private companies are staying private, right? So who's benefiting from that? People like Blackstones and Apollos of the world that are investing in those high DSTs of the world and SoftBanks of the world, right? That are investing and staying, keeping them longer. So how will a consumer participate in that type of a growth? So my view is that the alpha in the market is going to come from alternative investments over the next 10 years. And I really believe that despite of what might happen to the stock market, you will see a steady flow into the market, into the alternative investment landscape. Now, the other point to keep in mind, Nikhil, is that here in the United States, access to alternatives is less than 5% for an average consumer, even if you are an accredited investor, which is a higher level of definition in terms of, because SEC has certain rules of what type of product should be available to what type of investor. Compare that to over 50% exposure if you're in the top 1%, if you're a family office or you're an institution. So how is it that some of the best and the sophisticated investors in the world have 10 times more exposure to all? So there are lots of dynamics where we feel very strongly that alternatives are not only here to stay, but in the last 4 or 5 years, you have seen people gravitate towards that, and that will continue to happen.
That's a very interesting perspective. And Milind, if you look at just the stat you mentioned about the stock market, the proportion of Indian tech companies which are now generating value, privately held to publicly held, is probably even worse than in the US, right? Zomato, after a long time, is the first probably tech business that went public, but I would say 99% of the wealth is being created privately. And right. There is no access to the Indian common investor, the individual investor, to participate in that growth. It is actually largely either offshore money or large institutional family office money in India, right? That is benefiting from that wealth creation, and obviously now to some extent employees. But I think that's an interesting perspective, and that's why we're probably seeing a lot of money flow into venture into angel investing from an investor's perspective.
Yeah, absolutely. And you will see that with even Freshworks last week. What a great milestone. So it's incredible to see that. But again, 12-year-old company, and it debuted at $12 billion. Like, who benefited from 0 to 12, right? These were all private investors and private VC and growth equity firms,
Yeah, fair enough. The second point that you mentioned about in your previous answer was about how people are reinvesting very quickly on the platform, right? You also introduced, probably in the last 3 or 4 years, several new asset categories, both organically and through acquisitions. Do you typically see people move across these assets and then sort of increase their portfolio wallet share on Yieldstreet? Is that something that you see commonly, or people tend to have a particular focus towards investing?
Yeah, generally we see people building a diversified portfolio.
Okay.
Generally, a consumer, Nikhil, is they're really primarily two things matter to them. One is duration, because all these products are illiquid, right? And I think that's really why the stock markets have such a big liquidity premium, because people think or feel that they should have liquidity. The second, obviously, is the return profile, which is the yield. How much interest am I making on it? And then obviously both of those are heavily correlated with the type of risk that people want to take. And so asset classes, in our opinion, is a means to an end, right? Because we are an on-demand investment platform. We are not an asset manager, right? So if a big fund like a Blackstone raises money for real estate, $5 billion, they can only invest in that box of real estate, right? Like, if suppose there is a new investment in aviation, they can't really do it, right? Because it's not the mandate of the fund. If you think about a platform like Yieldstreet, we are an on-demand platform. So we really are driven by what a consumer would want. So for example, I'll give you an example. We launched something called single family rentals, which is a big category within real estate, right? So you buy a house and then you rent it out and then you generate income from it, right? And that category before the pandemic wasn't as hot, let's say, or like as sought after, because people started moving to suburbs. In the last 18 months or so, that category has become really very popular. And so for us, we can now dial up and keep investing in it till we feel that, hey, now there is a good enough exposure to our platform and to our investors, and then move on to something else that's like really driving it. So the products that we sell really are just a means to an end to help consumers kind of get wide exposure to a variety of different alts. And as you noted, we are probably the only platform that is really providing that horizontal exposure, because a lot of the platforms are very kind of vertically specific, and mostly in real estate, because that's the most widely held asset in terms of the size, and then variety of different real estate platforms. And so that's how we think about diversification.
Understood. I mean, somewhat related is also the persona of the user that is on the platform, right? And a broad maths would suggest that of a population base of the US, you have about 1%, a little bit more than 1% penetration. I'm assuming all of your users are US citizens. As you think about that moving over a period of time, are you also seeing your user base get diversified in terms of user persona, or are you still tapping very similar user bases in, say, the West Coast or the East Coast, people in the financial services or IT services who would tend to behave the same way?
So what we want to do, Nikhil, the mission really is to open it up to as many people as possible. And the goal of the company is to distribute $25 billion by 2025 outside the stock market. But I think the more important goal is to generate $3 billion of income for our user base. And so when we think about the persona, yes, all of those people that you mentioned, which are on each of the coast, professionals, doctors, lawyers, people who work for tech companies as well as for banks, but generally anybody who is wanting to diversify their portfolio. The opportunity in the US, just the market is just so big. So we think that there are 40 million consumers that can really benefit, both accredited investors and the high earning millennials, right? So these are the people in their 20s and 30s who are working for tech companies, who are professional and earn a 6-figure income. They can definitely benefit from the platform, and they collectively not only control several trillion, right? 20-30 trillion dollars of investable capital, but they are also going to be recipients. So if you look at the wealth trends in the United States over the next 2 decades, they're going to be recipients of tremendous, um, they're recipients of tremendous level of wealth that's coming from kind of baby boomers to generation XYZ. And so that's really where our focus area is going to be.
Understood. I mean, just to draw a comparison to what we are seeing, very similar. We're, our first year has been predominantly focused on tier one cities, very much the people working for tech companies, but we're increasingly seeing a lot of interest coming out of tier two cities, the Surats and Ahmedabads, where people are now coming and saying, because a lot of people there have also experienced working in the same set of companies, are looking for the same set of investment options, have the same set of disposable income, and are now looking to participate on the platform. So I think it's an interesting change that we are seeing on our side as well. I'm going to change the lens a little bit. We've talked about the market. We've talked about where the business is going. I'm going back to some of the basics of how you constructed the business, right? To us, the biggest challenge was creating trust on the platform, especially when you start on day one and you have no traction to prove for yourself to say that this is something worth investing in and your money is going to be protected and earn money here. Would love to hear from you what Yieldstreet did in its very early days, which you believe build that trust, enabled you to get the first 100,000, 10,000 users to say, okay, this is a new platform. Here's a new guy, new sort of team running the business, and I'll give them my $50,000.
Yeah, I think that's a great question. It was extremely hard, very, very hard, because 5-6 years back, investing online and investing thousands of dollars online was not very common. Okay, the only platforms that were generally available before that were like robo advisors, but it was generally investing in ETFs, which are a very well understood product here in the US for last several decades. So I think that was a really difficult part for the first couple of years. And tell you a funny story. When we started the company, I had a bet with my co-founder Michael. He said that, listen, I can bring all kinds of alternative products. You will not be able to bring consumers. And I said the other way around. I said, hey, you will have so much demand, you will not be able to kind of keep up, right? And really, if you think about it, first couple of years, we really took time to build trust. So the funny story was, like, in the early days, I would like block off some time on my calendar to call up my friends and family saying, hey, I've started this new platform and you should come and invest. And they would be very surprised, like, hey, what do you know about investing? You're calling and saying, hey, you can get 10% interest. Like, what are you doing? So the way to do that obviously is to have transparency and education. So even the day one, when we launched the website, we had tons of education content. We used to host webinars trying to explain to people using variety of different means what it means to get exposure to these type of investments. So education has always been a pretty key component. And if you interact and sign up on Yieldstreet, you will see that we do a ton of education material. The second aspect is transparency, right? And so we are a pretty transparent platform in terms of just all the data that we share with the users. And because I built it for myself, I tried to kind of emulate what I would want. So I'll give you one example. At the beginning, our investment generally give kind of monthly or quarterly returns, right? And so we used to send it back to our users' bank account. And I always kind of, you have your investment accounts on one side and then your banking accounts, right? If you look at your bank, generally what happens for most people is that you have your salary coming in and whole bunch of bills that you pay from that, right? But once they started seeing, oh, Yieldstreet, investment 2, investment 5, returning this capital, they were like, oh, wow, that's like a moment of joy for our users, right? And that was really something that I wanted for myself. And that really started establishing trust. And then you start sharing statistics as investments mature. That really kind of creates those moments of joy. So now, you basically, when you launch our mobile app, it will show you how much income or interest you've generated in the last 30 days. If you get text alerts when we make payments, right? And so, when you are kind of going through, like even last year, which was difficult for many people, when you get emails or text from us, that really kind of creates that level of trust for the consumers. And then ultimately, we have returned over $1.1 billion back to our investors, right? We've done close to 275 different investments on the platform. Over 160, 170 of them are fully matured and paid off. So, that obviously, as the time goes by, that creates that level of trust to create the virality and word of mouth.
Understood. Thank you for that. I definitely some of the things for us to pick up on and do a better job of. Milind, you also mentioned about, and you mentioned this twice, one is education and you mentioned self-serve platform, right? One of the challenges that we have is to build a really seamless platform where you can make an investment in 3 clicks, right? And everyone thinks about it in the tech world of giving a very, very quick experience. But at the same time, you want to build education and friction into the journey to make sure that the investor knows what he's getting into. How have you thought about this as you build a completely self-serve platform?
Yeah, I think that's a very important question. And listen, that's really where we actually don't agree that it should be very seamless, in the sense that it should be frictionless to the extent possible, right? So as an example, when you join up on the platform, to make the first investment, there is a lot of friction. You have to prove that you're accredited, upload a bunch of documents. Like there's just a lot of stuff there, right? Once we have verified that this user is appropriate to invest on the platform, then the investment process can be simpler, right? But I think the more important thing to kind of keep in mind is how do you make sure that the investor is engaging? So as an example, one of the things we've done right from day one is we announce investments many days before they launch, and so give investors ability to really understand the investments. The other thing we really use is that our kind of basic thinking on the platform and our marketing and content team, what we've tried to do is when you come on the investment offering page, it is a very good summary. It will take you, 10 to 20 minutes to read. What our standard is that, listen, share enough information that gives you all the details, right? And we say, like, if you read that executive summary page and if you cannot explain the deal to your mom, you should not invest. No deal should be so complicated that you cannot really explain and give a simple layman definition.
Yeah.
And then you can go into layers of information depending upon your interest levels. So some users may just look at the executive summary that gives us all the benefits, risk, how you're going to get paid, what is the fees, all of the key components, who the originator is, why we feel that the asset is protected. Then you can peel the onions and layers and go read either the subscription agreement, PPM. The PPM is as detailed as anywhere else, right? It could be anywhere from 20 pages to 60 pages that have all the detailed analysis. So you have to kind of strike that balance to ensure that consumers can invest on the platform. The other thing also is that we are not built for traders, right? We are not Robinhood. Obviously, more power to them. They're trying to bring a new type of consumer into the fold, but we don't want or expect our users to trade. And this is not as kind of a speculative, like, hey, you can read something on Reddit and then go jump, try to do some trades. This is really a thoughtful addition to your portfolio to kind of diversify your portfolio, as I said earlier. So we don't want people to kind of hurry and just invest. Like, they can take their time. And what we have strived to do, especially in the last 12 months, is always make sure that there are 2 or 3 investments that are open, so people don't feel that they have to invest immediately. They can take time to learn about them and then invest in them.
Got it. Okay, thank you, Milind. I'm seeing a lot of questions pop up on our chat box and Q&A, and I'll come to them in 5 minutes. But I want to move to the last section, which is more from you as your journey as a founder, right? And talk about the culture and building the team. To us, that is probably the most critical element of getting things right. You've had the chance to build two companies, be part of the growth of many other companies, and you've also had to acquire companies and bring that culture together. Any tips, any key learnings as you look back into the journey that you say that you got that right in terms of building that organization?
Oh yeah, I mean, listen, there are so many lessons. I think outside looking in, it always looks up and to the right, but it's always not that. It's like more of a sine curve. It kind of goes up and down. So Listen, for us and for me specifically, as a CEO, I have this formula called ABCD, right? You have to do four things as a CEO. So A is always be well capitalized, right? As startup growth companies, you want to have capital and resources to be able to grow. B is build talent, hire the best and really kind of, because they are the one that acquire and retaining a team that believes in the mission is really very important. C is communicate the vision. All of us as leaders have to do that to make sure that the team, as well as overall your or constituents, and it's very important even in a context of Yieldstreet, which is a consumer-driven business, right? So it's very important to communicate the vision. And D is ability to really delegate and decide. Like those are really two key traits of a leader, right? To be able to delegate to the great team that you build, but also make fast decisions. So having said that, for me, the ingredients of building a good culture is to empower the employee base, and really getting them to step up and take ownership is extremely important. For that, you have to hire a talented group of people that can actually believe in the mission, as well as in the leadership team, and have been very fortunate to have worked with some of the brightest minds. So those are some of the big lessons that I feel that are important for every kind of startup founder to kind of pay attention to. And then, by the way, things change at every inflection point. You need slightly different type of people. Your culture needs to evolve as the company evolves. And obviously there is great level of success here in the US, in India, in terms of last 10-15 years, some big companies coming out of India. So yeah, those are really some things to kind of pay attention to.
Yeah, you can read as many management books and you can try to get this, but it's challenging, and always looking for good advice. So thank you so much for that, Milind. I'm going to start by taking a few questions that we've received. I'll try to package them, so I'm trying to combine a few things that I've come across. The first question is, can Indians invest in Yieldstreet? And are you thinking about the European markets?
Yeah, so currently, unfortunately, Yieldstreet is open only to US taxpayers. So you could be in India, but as long as a US taxpayer, you could invest. European market, yes, we definitely have international expansion plans. But as I was saying earlier, US is a pretty large market, but we do have plans to go to Europe, as well as looking at Japan and a couple of other places in Asia. And hopefully, one day we will be in India as well.
Yeah, well, that takes away from our market, but okay, sure. we are happy to compete. Milind, the second question for you, and which is probably true for any investment platform, is about the risk and about default, right? As you've gone through this journey, while not specifically, but would love to get your perspective on how you think about risk, how you think about default, how you've reacted to some of the situations that I'm sure must have happened with respect to the total assets that you manage.
Yeah, absolutely. Yeah, risk. I mean, literally every investment across the globe, no matter in what category, has risk. So I think it's very important for the consumer to be educated about the risk. Obviously, you're getting high single-digit, double-digit returns because of efficiency of capital, right? Like if you're putting your money in the bank, especially in the US, you're getting 0% interest, right? Like literally, there is no interest. India obviously is still offering some interest on bank accounts. But even if you look at the trend in the last 10 to 15 years in India, it is down by almost 50-60%, right? In terms of the interest that used to be offered.
So it's negative, it's below the inflation rate. So it's
that's exactly right. So that's really where it catches up, right? And of course, the interest is so high because the inflation is also extremely high. So so you should absolutely make sure that you understand the risk. There are risks in investing, but there are risks in obviously stock market also, right? Apple stock goes down and up and down, and it happens. The way we manage risk really is that our platform really is in three aspects, right? Income generation, so yield. Capital appreciation, that's investing in equity, and then dislocation, where like what happened with COVID. And so if you are doing debt investments, you're like secured by assets, we try to do that. Our platform also is heavily reliant on bringing originators or asset managers on the platform, right? So when we do real estate deals, we really partner with originators that have anywhere from 5 to 30 years experience in that industry, and so obviously try to do that. We've had lots of defaults, we and workouts. We publish that case studies on that. We have a statistics page that gives people perspective on what happens in case of defaults and how you kind of manage those, and what are the workouts and things like that. So you have to really manage. But if you look at historically, even in the last 20 years broadly, within alternatives, you look at PE and other types of investments, they have outpaced S&P, right? And so you have to kind of balance that out. And again, it's a question of diversifying your portfolio. The same way you should not be overexposed to the stock market, you cannot be overexposed to illiquid private investments. And so how do you kind of build that the right diversification is very, very important.
And like you said before, I think transparency plays a key role here again, to be transparent with the investor community in terms of how those assets are performing and what's the likelihood of A, the risk, and B, of recovery. I think that principle just never goes away for anything. Milind, I'm also seeing a few questions to understand your perspective on adoption of alternative investments in emerging markets. I'm not sure if that's something that you may have looked at or evaluated, but if you have, would love to hear your thoughts.
Yeah, listen, I think alternatives, obviously have a huge, market in emerging markets. We have looked at historically, we've looked at some stuff in LATAM and also in Africa. But I think for us, just given like geographical differences and things like that, we've not really done thorough research. But I think tremendously the market exists. And it has been highly fragmented and disorganized. And Nikhil, you and I were speaking about that earlier in terms of some of the gaps that you yourself are trying to solve in India. And it's fragmented. And so it's done by high net worth individuals. And like NBFS in India, it's an asset class that have, developed over the last 10 to 15 years, but is not really managed kind of well, right? And so it's, with some asset managers that are, having exposure to that. So in my view, that market is going to continue to mature. And I think there is opportunity to do that,
Understood. I'm taking one last question that I can see you, and then I have a couple of more at my end to pick up. Coming back to how you introduced alternative investments to users, right? The first sales pitch that you made when alternative investments were probably not popular, you talked about less than 5% allocation to their portfolio. What was it that, from your perspective, convinced them to start in alternatives, not just in Yieldstreet, but actually take the first step towards moving from that 60-40 ratio and putting the first 5% in alternatives?
Yeah, listen, Nikhil, I think the big challenge really for us was how do we really educate them, because people didn't even know that they could invest in things like real estate. The main catalyst really is fractionalization, right, through technology that you can do, right? So it's not, people are either aware of it, but like my experience, right, where the investment minimums are so high to invest, like just you can't really afford it, right? And the second thing is, if you cannot afford it, then the second thing is, if you can afford it, then how do you kind of educate the consumer? So it's the combination of like, hey, lower minimums and access, and then educating to like let them know like these type of investments really exist. So that was really the pitch, that hey, now you could invest, and the minimums are lower. And what we tried to do, Nikhil, which is also very interesting, and we see that in our user base, is that we have products from like 3 months to 9 years. And historically we had products which was typically less than 5 years. And the idea there was the liquidity component, because there is not a very mature secondary market when it comes to alternative investments. So you're like locked into the deal, right? So how do you kind of create that rolling portfolio is very, very important.
Yeah, understood. I think we're seeing a similar challenge, maybe for you and for me. I'll take our time separately and I'll get more of your thoughts around it. Milind, one final question I'm going to pose to you, and before we let you go. At the SOL conference last week, you talked about an interesting change in strategy. And I'm assuming that this is in addition to what you're doing, but is a increasing focus on wealth advisors, on moving the platform towards wealth advisors as compared to individual investors. We're seeing something similar, and hence I'm very curious to hear what you may say about that and why that shift in focus.
Yeah, so listen, I think if you look at the consumer behavior, right, Nikhil, in the last 10 years, especially, it has changed quite a bit, especially because of mobile, and like everything is on demand. People want transparency. They want to make decisions on their own. So historically, wealth has been managed by advisor network here in the US, at least, right? Like there are just over 300,000 financial advisors and firms here in the US. So that was really the only way you could get access to it.
Right.
But what now companies like Yieldstreet and Robinhood and Acorns and my friend D Chaube's company went public, Money Lion, like neobanks. There's tons of stuff that's happening that is basically now bringing a new type of consumer that wants access to these type of products, and the product spectrum can vary. So I think over the next 10 years, we see that there will be direct penetration in alts, as well as continued penetration through the financial advisory channel. So if you think about the consumer, especially in the US, right, there is one consumer that is with financial advisors that is served and is happy. And those are probably a little bit of older consumer that are not going to move to digital platform, somebody that is 60, 65 plus, right? Then there are consumers like me who have a financial advisor, but so are served, but are not happy, right? And so that's like a big bucket. And then there are the consumer that is underserved and underrepresented. And so that's like the later two categories are what kind of Yieldstreet is, obviously focusing on. And then, we see that channel to be a critical aspect of it. We're talking to several partners to like complement our direct strategy, using channels also. One of the things that we are passionate about is to make sure that there is less friction in terms of having various touch points, because if you have many people in the value chain, then you have to pay for all of those touch points, right? And so you don't want to make the product expensive to the end consumer. So we want to make sure that if we go through the channel are effective in creating value to the end consumer. Otherwise, they can always come direct and buy direct. So like that's really how we see the market emerge.
Understood. Okay. What does the next, apart from the 25 billion target that you communicated earlier, what does the next 5 years for Yieldstreet look like? What do we expect?
Yeah, so Nikhil, I think I personally feel that we're entering the golden age of fintech. Okay, my view was last decade was the golden age of tech. Top 3 of the 10 companies in 2010 were tech companies. When we ended the decade, 7 out of top 10 companies in the world were tech companies, right? And so I feel that we are entering the golden age of fintech, and with the blockchain and embedded finance, right? Financial services are really slow to really adopt, right? So if you think about the innovation, last 20 years, digital payments has been the only like big kind of innovation, and now blockchain and digital currencies are emerging. So how do you really deliver financial services to the masses, especially from wealth management perspective? And how do you make it easy for people to access them, understand them, and then actually execute and build a portfolio? That is going to be very important. The other aspect is the concept of kind of self-driving money, right? So historically, if you think about our parents' generation, they said, hey, we're going to retire, so let's save for 30 years. Now, millennials and people are living very different lives. They're switching jobs, taking time off, so they need that income to pay for some of the lifestyle that they're doing, right? And so how do you kind of blend that, where on one side you're earning income and then like really using that to pay some of your life's needs in the short term? So those workflows, in my opinion, will be incredible. I think the whole concept around embedded finance and blockchain will help us reduce friction points and take cost out of the value chain, which will ultimately benefit the consumer. So we feel that those trends are going to continue to emerge, and there is going to be tremendous opportunity for consumers to like really get get more out of their financial life, and not to be so worried about it, and like get that transparency and somebody thinking about them and about their money versus they feeling really anxious about it. So I think you will see some of the work in those areas really kind of blossom, if you will.
Okay, perfect. Milind, I started the session by saying that you were the reason for our inspiration and for what we've seen the last year. I think this conversation has more than inspired us to think about the next 5 years for Grip and what all we need to do and the opportunity in front of us. Thank you so much for taking this time out. Really appreciate it, and for all those insights. Would like to also thank everyone for joining this call. I know there are some questions which have been unanswered. Those were all directed towards me and to Grip, and I didn't want to take a minute to answer them. We'll definitely come back to all of those users separately and answer their questions. Milind, thank you once again, and I hope you have a great weekend.
Thank you so much, Nikhil, for having me.
Bye. See you, Milind.